Obviously, with the pandemic, COVID-19, which is creating economic challenges globally and real distress for consumers and businesses around the world, that we were able to maintain profitability through the first half. Our revenues, as you noted, were up 8% year over year for the first half, well over 11 billion pounds. And remaining profitable in an environment like this is obviously, I think, very important for a bank. But being reflective of where the economy is right now, we have been very conservative in the economic data and forecasts that we have used for our impairment models. That has meant that we have set aside in the first half 3.7 billion pounds of impairment reserves, again on very conservative economic assumptions going forward in terms of unemployment and GDP, particularly in the UK and in the US. But maintaining the profitability level that we did, that allowed us to print the highest level of capital in the history of the bank. Our CET1 ratio, our capital to risk-weighted assets, was 14.2% at the end of June. So we remain very capitalized. The bank is very liquid. We sustained our profitability in face of this pandemic, and that allowed us to, first and foremost, help our customers and clients around the world.
Jes, obviously the market's very sensitive to the impairment number. So given that the analysts see this number nudging up to more like 6 billion for the full year, how realistic do you think that figure is, and how conservative given what you're seeing in current trading?
So I think the vast majority of that 3.7 billion impairment reserve in the first half are basically reserves that we have taken on the basis of our risk models and the economic assumptions we put in those risk models. We've put in very conservative numbers, again, unemployment, et cetera. Right now, how we see the economy is functioning is actually slightly better than the assumptions we've put into our models. So we think that we've been very conservative in the first and second quarter, and we would expect, if trends continue, that the impairment numbers would begin to normalize in the second half of this year.
I want to ask you what you're seeing in your cards business, in particular in international cards, because I know U.S. credit cards can be a very good way to track the U.S. economy. So based on what you've seen this quarter and what you're seeing in terms of exit rate for the quarter, what is your latest view on the shape of the recovery?
We've always stated that the biggest credit risk at Barclays is our unsecured consumer loan book, i.e. the credit card business, particularly in the UK and the US. We felt that in the first half of the year, and in fact our international consumer business generated a loss in the first half. But we've been very conservative again on our impairment numbers. Our coverage ratio, our impairment numbers against that credit card portfolio now is about 12% of total receivables, which is quite a high coverage ratio. So we think we are very much insured to a degree of challenges we may have in the second half of this year and next year. But we like that business. Again, spend is beginning to recover. We gave hundreds of thousands of customers payment holidays in their credit card payments. Those holidays have come to an end. They pretty much all, the vast majority, well over 80% of our credit card customers have began normal repayment schedules. So it is a business that will be challenged when unemployment spikes up, which we have anticipated. But fundamentally, I think the business is still very sound.